Hi, welcome to case study video number 10. This video tells how to analyze a company using cash flow statement, because the cash flow statement consists the three activities: operating activities, investing activities, and financing activities. So by analyzing these three, the company's performance can be analyzed. That's the concept which we are going to look at in this video. Before that, we should know what is cash flow, and then we'll see what is cash flow statement. Then we'll be seeing one by one. Cash flow is the net cash and cash equivalent transferred in and out of a company. Cash received represent inflows, while money spent represent outflows. A company creates value for shareholders through its ability to generate positive cash flows and maximize the long-term free cash flow (FCF). This is the cash from normal business operations after subtracting any monies which spent on capital expenditure, that is CapEx. Cash flow is a movement of money in and out of the company. Cash received signifies inflows, cash spent signifies cash outflow. Cash flow statement is one of the financial statements that reports a company's sources and uses of cash over time. Actually, it records actual cash inflow and actual cash outflow. Cash flow statement does not shows accrual concept, does not record accrual transactions. A company's cash flow can be categorized as cash flow from operations, cash flow from investing, and cash flow from financing. Let's understanding the cash flow. Business take in money from sale as revenue, that is inflow, as spend money on expenses, outflow. They may also receive income from interest or investment, income from royalties, and income from licensing agreement, and sell products on credit. Assessing cash flow is essential for evaluating company's liquidity, flexibility, and overall financial performance. Positive cash flow indicates that the company's liquid assets are increasing. Suppose in a cash flow statement in operational activities over the period, let's say example 5 years, we are comparing cash flow statements operational activities for 5 years. Out of 5 years, any of the 2 years showing negative cash flow, that indicates the company might end up with a loss, or the company's operating cash inflow might be decreased over the period and end up with a negative cash flow. If the operational activities cash flow shows positive signs, if it is increasing over the period also, then it is a good sign. That means the company is consistently making money from its operational activity, either by making profit or through other income. So positive cash flow indicates a company's liquid assets are increasing, enabling it to cover obligations, reinvestments, business. Suppose if the company's cash flow, net cash flow from operating activities is increasing over the period, means the company can use those funds to cover the long-term or short-term obligations, to repay the loan, or to invest that money in the business, or return money to the shareholders in the form of dividend, or pay any form of expenses. That the company can do. If the operational activities is going down, that is the cash flow from operating activities going down, then it signals negative. It shows the company don't have enough money to meet obligations or to repay the loan. Then the company will be pushed to borrow more money end up in a negative cash flow. It's not good sign for the company. So operational activity is very, very important for any business to see whether the business is going on smoothly or not. So that can be seen from income statement of the company, and the investment activities and the financing activities can be seen from balance sheet of the company. The information from the income statement and the balance sheet is used to create the cash flow statement, and the income statement will give you the information about the cash that is entered into the business and left from your business. The balance sheet gives you information about the account receivable, payable and inventory. This can be understood with the following statement. The statement of cash flow will help in evaluating the business. Future cash flow projections are made possible by the statement of cash flow. The following aspects can be analyzed by looking at the cash flow statement. We can determine the financial position of the business. Cash projections and requirement of cash for the business can be determined. The volume of cash deficiency and can be determined by the cash flow statement. Helps in forecasting the ability of the firm. For short-term analysis, it is much easier to understand than the funds flow statement. So these are all the understanding of cash flow statement. Thank you.